Hello, Econ students. This is Mr. Stark, getting ready to give you your final economics lecture PowerPoint for your time in economics. I just want to say again that I've missed seeing you all and look forward to seeing you all next year. And hopefully, if you don't have me in class in political science or anthropology, I'll still see you around and you'll drop in and say hi. But today we're going to finish up by talking about stocks and bonds and how people make money in the stock market, something that has been very much in the news over the last couple months. So let's go ahead and get started. So if you recall, corporations split themselves up into tiny pieces called stock or shares, and they offer those pieces for sale for anybody who wants to buy them, has the money, anybody over the age of 18. So a stock is when you're actually a part owner in a corporation. You own a small piece. Now, most very large companies, Fortune 500s, have hundreds of thousands, if not millions, of stock. So if you own one or two or even 100, you're still a very, very, very small owner, but you are still an owner nonetheless. The benefit is if the company does well and makes money, if you have one type of stock, you actually might get a share of that profit they made. Everybody who owns stock, regardless of the type you get, if a company does well, then the stock goes up in price. So if you want to sell your stock back at a higher price, and you do, well then you just made money on it. So obviously, there's the potential for people to own significant stock. Now, to give you kind of a reference, Bill Gates, who just kind of recently kind of stepped away from the Microsoft Corporation, at his height, out of the millions of stock that was available for Microsoft, he owned around 4 to 5% of it. So, but he owned the most. He really wasn't what's called a majority owner. He was what's called a plurality. He owned more than anybody else. But again, he owned 4 or 5% of millions of stock in Microsoft, which is why he was in charge. And obviously, stocks can vary in price. You have some companies like Amazon, Google, which can cost hundreds or even thousands per stock. And you have, what's called penny stocks, small businesses whose stocks, either because they're not doing very well or just because their company split up into several different pieces and the company's not very big, is really only worth pennies or nickels. Or you have big companies like JCPenney, who is on their way down and their stock's been going down for a long time. They're planning to declare bankruptcy in the next several weeks, and so their stock is on their way probably to nothing. And we'll talk more about that here in a minute. So why do people buy stocks? Well, ultimately to make money. That's the main reason. Now there are kind of two strategies. One strategy is we buy stock daily and sell it daily. So stock, let's say if your stock's worth $100 today when you buy it, at the end of the day it's worth $105. You sell it, you made $5. That might not sound like a lot, but if you have 1,000 stock, you made $5,000 in one day. That's day trading. Most people do it for long-term financial planning, like for retirement. So like you've heard of 401ks or 403bs or IRAs, which stands for individual retirement accounts. Those are basically retirement plans, so you can put money in, and then who manages those accounts puts them in the stock market. And you can obviously determine what kind of risk you want and which stocks you put it in or let them decide. But the first way you make money is what's called dividend payments. And this means that you actually, if let's say Apple made $50 billion in profit one year, well, several billion of that goes to shareholders that own a very specific kind of stock that gives them a share of those profits. Most people make money off of what's called capital gains. That's basically reselling a stock for profit. Kind of think of it this way. You've probably seen those house shows, the Flip or Flop or whatever, where people buy houses that are, not in the best condition, or they're in decent condition, but they, buy them for a cheap price, they fix them up, then they sell them for a much higher price, which allows them to make money off of it. That's pretty much the same principle as capital gains with stock. You buy stocks when they're cheap, ideally. You sell them back on the stock market when they are more expensive, and you get to keep the money. People can become millionaires or even billionaires overnight, depending on what they invest in and how much they invest in it. For example, if you would have invested in Google 20 years ago when they were still an up-and-coming company, if you would have bought 1,000 shares, you would have made millions on those shares today, based on how much Google has gone up in price. On the other hand, you can also lose millions as well if your company goes all the way down. So yeah, or it's like flipping a car, the example here. Now there's two types of stock. Both of them represent ownership, but some of them give you different perks. For example, common stock, you actually get voting rights. Now typically, unless you own a lot of common stock, you actually don't vote or get to vote for what goes on in the business. You know, if you own one share of common stock in Amazon, you don't get to have Jeff Bezos' phone number on speed dial to tell him what you want done. It's not the way it works. But you do potentially get voting rights for common stock. Preferred stock, you do not get voting rights. However, you do get those dividend payments. Companies that make profit, they send checks at the end of the year to the stockholders of that preferred stock, which is a piece of that profit. So that's the benefit of preferred stock. So common and preferred, like its name suggests, common is definitely the most numerous type of stock. Stocks are sold at markets. Now most markets you buy them and sell them online today, but there's also physical markets. For example, the New York Stock Exchange is a market where stocks are bought and sold on a daily basis. Lots of other ones as well. Here are an example of some different stock exchanges, places where stocks are bought and sold throughout the world. There's one in Chicago. There's ones all over our country and all over the world, really. Now, you might have heard of something called a stock index, like the Dow Jones. So like, for example, today the Dow Jones is around 24,000 plus. It's down a few $100s. Basically, the Dow Jones is a list of the 30, probably some 30 of the largest countries or companies in the United States. So basically, if you want to know how the stock market, and stock market's one of those things that indicates how the economy is doing. When the stock market's doing well, usually the economy is well. Stock market's down, usually the economy is not doing the greatest. You can go through every single stock on the stock market and look at them and see how it's doing in an average amount. That takes a lot of time. Or you can look at what's called an index. For example, when you get your blood taken at the doctor and they do tests on you, they give you pages and pages of different tests they've done on it, but they really boil it down to like 5 or 6 critical tests to see if you're healthy or not. You can look through each 30 or some tests and see if you're healthy, but if you look at the first page, it gives you like 5 or 6 main tests and whether you're healthy or not in those. Stock indexes are a shortcut. They basically tell you a snapshot of how the stock market's doing based on the largest companies and several types of companies. So you have everything on the Dow Jones, the 30 from Coca-Cola to Disney, Walmart, IBM, Johnson & Johnson, all Fortune 500 companies easily. So this gives you an idea of how the stock market's doing without looking at all the stocks, so it's kind of a shortcut. The S&P 500, which is the Standard & Poor's 500, that's 500 companies. That's probably a little more accurate, but it takes a longer time looking at the different companies. And then you have what's called the NASDAQ, which is a variation of companies, most of them technology companies, research and tech companies as well. Stockbrokers are people that actually work in stock exchanges. They're the ones that buy and sell stocks for customers. So if you buy or sell a stock on, let's say, E-Trade, which is a website, there's E-Trade stockbrokers, which are down in the stock markets, stock markets buying them in the stock exchanges. Couple other things. Well, that's the stock index, like I was telling you about. Um, so the S&P 500, the Dow. Just to give you an indication, the Dow, as of about 3 months ago, was about 30,000, went all the way down to 19,000 within 4 or 5 weeks. So it decreased a lot. A lot of wealth was lost. It's recovered about half that. It's around 24,000 right now. By no means a recovery, but not quite to where it was, 8, 9 weeks ago when coronavirus shutdowns were just starting to become apparent. A couple terms you will need to know. You might hear these. A bull market is when stock prices are going up. That usually means the economy is doing well. Businesses are becoming more valuable. They're hiring more people. They're producing more stuff. The GDP is up. A bull market is when the stock market goes up over a period of time. Up until 3 months ago, we had about, I would say, a 7 to 8 year bull market, which was one of the longest on history. Now remember the business cycle. Every good thing comes to an end. So it had to end sooner or later. If coronavirus didn't do it, something else probably would have made the market go down. And when the market starts going down for a period of time, that's called a bear market. So it's declining steadily over a fairly long period of time. We are in the middle of somewhat of a bear market, and it probably is going to be that way for a little bit of time. Again, remember the business cycle. The good news is it will come to an end eventually, and a bull market will start again. We don't know when, we don't know how long, but it will. It will shift back to a bull market. So each market has a winner and a loser. The bull market, if you already own stock, your stock's going up in value. You're winning. You're doing really well. The loser is if you're trying to buy stock. Well, the stock's more expensive, so you're losing in that situation. In a bear market, things aren't great right now, but if you have money, this is the time to invest in companies that you wouldn't be able to afford otherwise because their prices are, 25, 30% cheaper than they usually would be. And again, if you have time to let the market go up, it's a good idea to buy now because those markets will go up in the coming months and years. We just don't know how long it will take. And if you have, 10, 20, 30, 40 years, if you're investing your money for your retirement, the stock you buy today most likely will be worth significantly more when you're ready to sell it during your retirement. So again, during a bear market, if you're wanting to buy stock, you're a winner. If you already own stock, technically you're a loser, but again, it's a long-term gain. There's been no 20-year period of time where the stock market didn't make money. Never. And that's still predicted even with the way things are today. So if you have parents have money in the stock market, they probably have several, 15, 20, 30 years until they need it. The money they've lost over the last couple months will be recovered over time. That's just conventional wisdom in the stock market. So let's go ahead and look at the basics of stock investing. So again, when you're buying a stock, you're buying a portion of a company. You want to buy companies that you think will be profitable in the future, not companies that are on their way down, like JCPenney. Okay. Typically, if you want to invest, you invest a pretty significant amount. Again, the more you invest, the more you put in. Typically, the more you'll get out when you need it. Most people, what's called buy and hold for the long term. Again, that's people that don't need it right away. They're putting in the stock market for their retirement 10, 20, 30, 40 years away. And again, most usually it's in an IRA, which is you can open that out. Any bank can get you an IRA, or if your job offers 401ks or 403bs, basically the same thing with a few differences. Those are retirement plans that will also invest in the stock market. And many times your companies with 401ks and 403bs will put money in there as well. You don't just have to put your money in there. They'll also put money in there as well as a benefit. So again, stocks are investment in a single corporation. If your stock does well, you make a lot of money. If it's just one company, you're putting all your eggs in one basket. If your stock does poorly, you can lose a lot of money. So stocks are very risky, just individual stocks. There is middle ground. Those are called mutual funds. Mutual funds are baskets of stocks you can buy in bulk. For example, like you can buy like someone a gift basket that has all kinds of different foods and different, nice little trinkets in it. You can buy baskets of stocks and bonds, which we'll get to in a second. Um, these are called mutual funds. Oftentimes they're a mix of different kinds of stocks. You have like energy stocks or technology stocks or all kinds of different high and low risk stocks. These are more of a moderate risk because if one of the companies in the mutual fund goes down, you have lots of others that have the potential to go up. So there's a significant less risk in mutual funds. Disadvantage, there's not as much potential to make a lot of money, especially quickly. So you're starting to see a pattern probably. If you want to make more money faster, you're going to have to accept more risk. If you want to protect your money more, so less risk, there's much less potential for more money. There is no such thing as a low risk, high profit or high earning stock or mutual fund or bond. That does not happen. The only reason you make money fast is because you take a risk, you roll the dice, you make a good call, you make a lot of money, Very well could have turned badly for you. The lowest risk of investments is called a bond. Now, a bond is different from a stock. A stock, you are the owner of a company. With a bond, you are loaning the company money. So you are a lender or the government. You've probably heard of war bonds. That's the government basically offering bonds. People buy them and they promise to pay them back plus profit in 1, 2, 5, 10, 20 years with interest. So again, bonds are the lowest amount of risk, but you're not an owner. And if the company stays alive, when your bond is up after 10 years, if it's a 10-year bond, you get your money back plus interest that's been accruing on it for those 10 years. So you can make, 1, 2, 5. So you can make 1, 2, 3, even maybe 4% interest, which can keep you ahead of inflation. Inflation is typically 1 to 3%. So bonds are going to earn you, usually with the stock market, you can get well over 5% earnings on your investments, sometimes even more than that, many times more than that. Again, bonds, less risky. Usually unless a business goes totally bankrupt, your bonds will still collect their interest when the term is up. With government bonds, they're as safe as the government is stable. Our government's pretty stable, so government bonds are a pretty safe bet. Many times if you buy mutual funds, they'll have a mix of bonds and stocks as well, just to mix up the level of risk. So review. The least risky but the lowest rate of return, those are bonds. The most risky but can have a very high rate of return at times, that's individual stocks. And moderate risk that's spread out among many companies. Again, these are baskets of stocks and bonds. You can buy together in a basket. Those are mutual funds. So now we are going to look at how people make money on the stock market. And I'm going to be posting a video that shows you how to calculate what's called capital gains, how you make money on the stock market. And I'm going to use a couple of examples. I'm going to use Microsoft, and then I'm also going to use Adidas, clothing and shoe company, as an example on the video. It's crucial that you watch the video to see how you calculate capital gains, because you will have to do it on the quiz next class. It's fairly simple. It's just simple addition, subtraction, multiplication, and division, but there are several steps, and I'm going to walk you through them on the video. That's all I've got for you guys this semester. Don't worry about calculating the compound interest formula. You did that in math already probably, or you will. We would have gotten to that eventually, but we didn't this time. So again, I miss you all. Let me know if you have any questions or need any assistance. This is Stark out.